There are three areas of major concern that I have in the economy right now, and we'll be breaking down in this video each individual one, starting with GDP, moving into home equity lines of credit, and finishing it off with a topic that I've covered before, stagflation. Now, if you stay tuned to the end, we'll be discussing how I'm particularly playing how this could potentially unfold, so stay tuned for that. But if this is your first time here, my name's Nick. Welcome to Waste of Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. We will be covering this with a Canadian-minded spectrum, but I understand that a lot of these different things are happening throughout the world. So do your own research depending on each individual category. With that being said, number one is GDP. And we saw the Canadian economy shrank by 1.1% in the second quarter of 2021. Now, first things first, you would think, hey, we should be rebounding from the original lockdowns that we had in March. That is not the case. Secondary thought that comes into your mind: we are printing so much money right now. How could the economy not be doing well? What more can we do? So we see here that Canada's economy had its worst quarterly stretch since the start of the pandemic, contracting at an annualized rate of 1.1% between April to June and possibly dropping further in July. The decrease in GDP in the second quarter was the first quarterly contraction recorded since the sharp drop during the same stretch 1 year earlier. Now, we know all about the lockdowns and what that had in regards to what had happened in the economy. But what we'll be looking at now is a chart that I put together on trading economics here, and it's Canadian GDP versus the Canada's government debt. So GDP is the blue line, and then we also have Canada's government debt in the black dotted line. We see that this traditionally goes in an uptrend. So the more the government prints, the more likely the economy is set to do better because of spending and so forth. But what we see on the tail end of this graph is we see, government spending continue to increase, and we've seen that in the platforms that all the government parties have. And we see this decrease here in the GDP. So this is kind of leading on to the third point, but just to keep fresh in your mind, one of the tools that government uses in order to get the economy back on track is to print money. Well, we're seeing right now that in Q2, those measures aren't working as well. If we continue to print more, it doesn't end up well. The second point that we're going to be discussing today is home equity lines of credit, also referred to as HELOCs. And what this is basically people using their house as equity. So they go to the bank, they say, hey, my house price has risen 100% since 2014. I'd like to pull some money out against the value of my home and use that for spending, whether they're investing that money, renovations, etc., etc. Well, we got some interesting news, and that's the fact that we saw this number jump 56.7% in the second quarter compared to a year earlier. Now, where the concern comes in, there's two parts for me. Me personally, as an investor, I'd like to use cash. I don't like to use debt in order to finance other investments. I understand that the interest rates are at all-time lows and there is opportunities to take advantage. Not my personal investing style, but definitely investing style of some other people, as we've seen by this 57% increase. But the second part is because interest rates are so low, and because this is a potential metric for the Bank of Canada to increase, and these HELOCs tend to be on a variable rate, meaning they move with the Bank of Canada. Well, if these raise uncontrollably, well, then all of a sudden people will have to pay back more than they expected. So this debt can kind of run out of control a little bit. So that is the second portion of concern here. And where this ties in is we can see here is a chart that I pulled out, and it's called Housing's heavy weight on GDP. So after exports, a key driver of Canada's Q2 GDP contraction was a 12.4% annualized dive in residential construction. Despite more home building and renovation spending, this segment fell due to a retreat in ownership transfer costs as sales pulled back. And timely reminder that the housing sector is now a large slice of GDP. 10.1% of our GDP is built in our housing. All of our liquidity, all of our wealth is wrapped up in our home prices. And you can't really even get that out unless you're using HELOCs. And if the Bank of Canada raises those interest rates, then it kind of seems like this domino effect that may, come crumbling down. Now, I'm not saying it's going to, but this is what's worrying me. This is what's concerning me. We see this number at a 10% of our GDP is just our housing market. Like, that is absolutely incredible. And that brings me kind of to the inflation rate and stagflation conversation. So number 3, we look at the inflation rate now. This is a max chart, and it does look to be kind of bouncing around that 0 to 5% in the last 21 years. But if you break that down a little bit further and you look at 1 year, we're definitely in an uptrend. This is definitely a cause for concern. Bank of Canada thinks that it's transitory. It's just going to be as we get through this mess, where other people are starting to think that it's going to be uncontrolled. If we don't start raising interest rates and if we don't stop printing money, then this could potentially be heading into what we saw back in the 60s into the 80s, which is a interest rate that goes from 0 all the way up to 15. If you remember back in those days, if you date back that far in the 80s, you had mortgage rates, your interest rate there was almost 20%, 18 to 20%. So this is a concern that we are heading back into this area. Now, if you're not familiar with stagflation, I'll link the video I did on it before. But the first part, it's stagnant economy, a GDP that's not really moving anywhere, and then inflation happening on the back end. So a combination of an economy that's not doing anything and inflation prices rising. So that's where, we're going to get into the nitty gritty here. And what we're going to do is our first stop is to look at how investments performed during that last period of stagnation, the 60s to the 80s. And we come to this Wall Street Journal article here, and we see annualized return from 1966 all the way through to 1982. T-bills did the best at 7%. Intermediate term treasuries, 7%. S&P did 6.82, which is not bad, but it is important to note that it did just as well as inflation. So just merely better. If you remember inflation, it's the product services increasing. If your wages aren't increasing at that regular rate, then you effectively can buy less today than what you worked for and the money that you earned the month before. So that is interesting to concern, but it is important to note that this time is different. We don't know past performance and how that will kind of equate to the future. We can use it as indicators, but it's not always as much of a flow as like a cookie cutter scenario that we can kind of piggyback off of per se. So I found this article here on Reuters. Stagflation trades boom as investors flee U.S. debt. They talk a little bit about inflows going into U.S. treasuries, which was an indicator before in the 66 to 82 that we just looked at. Emerging market is definitely an opportunity. But I think, what I'm looking at moving forward is kind of similar to what I'm reading here. So our view is that long quality major stocks is the best market and macro hedge in a backdrop of stagflation and waning fiscal and monetary policy stimulus. So what does this mean? This means that companies that are in the tech sector that are actually doing well or, companies that are continuously growing the revenue, growing the bottom line. These are areas that you want to be in. You want to take your foot off of the gambles, the penny stocks, the ones that aren't making money as of right now. And you want to focus on companies that are making money. And the companies that I'm focusing on are FANG, your Facebook, Apple, Amazon. I like Microsoft in there, and Google. These companies are absolutely fantastic. And what I consider to be the new consumer staple, what used to be the Cokes and the Johnson and Johnsons of the world. Yeah, okay, they'll float. You'll clip your dividend yield. But what you're going to see is that how many people can live without Instagram? How many people can live without Amazon? How many people can live without YouTube and Google? These are the core companies. And if anything goes wrong in the market, these are the places that you want to be in. Now, I know you look at these stock prices and you might think, well, they're a little bit too high. Well, the way to play that is by playing a NASDAQ top 100. So if you're in the US, QQQ, or on the Canadian side, there's ZNQ.TO. It's a BMO product. And then there's also TEC.TO, which is a TD bank, which covers these tech names that are kind of moving into the future. It's tough to look at the valuations, but at the end of the day, these companies are going to grow top and bottom line by double-digit percentages, at least for the next 5 years. So if there is anything crumbling, or if there is anything of worry and there's more concern that we see here than what I've stated, and it comes to fruition, I hope it doesn't. I think the move is to move into these FANG names. Those would be the ones that I'd be looking at. But I hope you enjoyed the video. I hope you learned something new. If you're still here with me, don't forget, hit that like button. And if you haven't already, please consider hitting that subscribe button. I hope you all have a great week in the markets. Happy trading.